Nicolas Maduro has been officially sworn in for another term as Venezuela's president. This event raises critical questions, not just for Venezuela, but for the global economy. One of the biggest concerns is how his continued leadership will impact U.S. oil interests and the sanctions imposed on Venezuela. For years, Venezuela has been at the center of U.S. foreign policy due to its vast oil reserves and political instability. But now, as Maduro consolidates power once again, will the United States adjust its stance? Will there be tighter sanctions, or will economic and geopolitical interests push for a more flexible approach? The importance of Venezuela's oil in global markets. To understand the stakes, we first need to look at Venezuela's oil industry. The country possesses some of the largest crude oil reserves in the world, even surpassing Saudi Arabia. However, its oil production has drastically declined due to mismanagement, corruption, and years of sanctions. Before sanctions tightened, Venezuela was one of the top oil suppliers to the United States. But after 2019, U.S. sanctions cut off Venezuela from American refineries, forcing it to rely on China, Russia, and other nations to sell its oil. Currently, Venezuela's oil production remains well below its potential. Despite having the world's largest oil reserves, its output is only a fraction of what it once was. In the early 2000s, Venezuela produced nearly 3.5 million barrels per day. Today, that number has dropped to around 750,000 barrels per day, a dramatic fall that highlights the country's economic struggles. So, with Maduro staying in power, does this mean Venezuela's oil sector will remain isolated from the U.S., or is there an opportunity for change? Chevron's role in the U.S. oil connection. One of the few companies still maintaining operations in Venezuela is Chevron, a major U.S. oil company. In 2022, the Biden administration granted Chevron a special license to extract and export Venezuelan oil under strict conditions. This deal was made to help stabilize global oil prices, especially after the supply chain disruptions caused by the war in Ukraine. Chevron's involvement in Venezuela has been a point of strategic interest for the U.S. On one hand, allowing an American company to extract Venezuelan oil could ensure some control over the supply and pricing of crude. On the other, critics argue that these deals indirectly support the Maduro government, reducing the effectiveness of economic sanctions. With Maduro's re-inauguration, will the U.S. allow Chevron to expand its operations, or will it reimpose stricter restrictions? The answer depends on how Venezuela aligns itself with global economic trends and its relations with U.S. adversaries like China and Russia. The geopolitical angle. Venezuela's growing ties with China and Russia. Another crucial factor in this discussion is Venezuela's geopolitical alliances. Over the years, the country has grown increasingly close to nations like China, Russia, and Iran, all of which have tense relations with the U.S. China, in particular, has been a major buyer of Venezuelan oil, often paying for crude through indirect transactions to avoid U.S. sanctions. Similarly, Russia has provided economic and military assistance to Venezuela, helping Maduro maintain his grip on power. With Maduro staying in office, these relationships are expected to strengthen. If the U.S. continues strict sanctions, Venezuela could further distance itself from American influence, deepening its economic reliance on China and Russia. This could create new trade routes that bypass U.S. financial controls, weakening Washington's leverage over the Venezuelan government. The big question remains: will the U.S. allow this to happen, or will it try a different approach to regain influence in Venezuela? The future of U.S. sanctions on Venezuela. Since 2017, U.S. sanctions on Venezuela have included restrictions on oil exports, financial transactions, and government officials. These measures were designed to weaken Maduro's regime and push for democratic reforms. However, sanctions have had mixed results. While they have significantly impacted Venezuela's economy, they have not led to a change in government. Instead, Maduro has adapted by strengthening ties with U.S. rivals and finding alternative economic lifelines. There are now two possible paths for the future of U.S. sanctions. A harder stance. The U.S. could double down on restrictions, enforcing stricter penalties on companies or nations that engage with Venezuela. This would limit Maduro's ability to sell oil but could also raise global crude prices, affecting American consumers. A more flexible approach. The U.S. could gradually ease some sanctions in exchange for economic or political concessions from Maduro's government. This would allow American companies to resume business in Venezuela while maintaining some diplomatic pressure. Each option comes with risks. Lifting sanctions could be seen as legitimizing Maduro's presidency, while keeping them in place could further push Venezuela into China and Russia's economic sphere. U.S. domestic energy policy. Does the U.S. still need Venezuelan oil? Another major factor in this debate is U.S. energy independence. In recent years, the United States has significantly increased its own domestic oil production. Thanks to technological advancements like fracking, the U.S. has become one of the world's largest energy producers. However, despite this growth, the global oil market remains interconnected. Any disruptions in supply, whether from the Middle East, Russia, or Venezuela, can impact fuel prices in the U.S. If Venezuela were to significantly boost its oil production, it could help stabilize global prices and reduce inflationary pressures. But given Maduro's history of economic mismanagement, there is no guarantee that Venezuela can efficiently ramp up production anytime soon. The economic and social impact on Venezuela for Venezuelans. This is not just about geopolitics or oil revenues, it's about survival. Years of economic decline, hyperinflation, and shortages have left millions struggling to meet basic needs. The country's currency, the bolivar, has lost most of its value, and many Venezuelans rely on US dollars for everyday transactions. This partial dollarization of the economy has provided some stability, but long-term growth remains uncertain. If US sanctions remain in place, Venezuela's economic recovery could be further delayed. On the other hand, if Maduro secures new oil deals with China or other partners, the country could see short-term economic relief, but at the cost of becoming more dependent on foreign powers. What happens next? So, what can we expect in the coming months? Experts predict that the U.S. will take a cautious approach. Instead of lifting or reinforcing sanctions overnight, Washington may adopt a step-by-step strategy, adjusting policies based on Maduro's actions. There will also be pressure from regional allies like Colombia, Brazil, and Mexico, who may advocate for a more diplomatic solution rather than prolonged economic isolation. One thing is certain: Maduro's inauguration is not just a domestic political event. It has major consequences for global energy markets, U.S. foreign policy, and even the prices Americans pay at the pump. What do you think? Should the U.S. continue its current policy on Venezuela, or should it explore new economic and diplomatic strategies? Let us know in the comments below. And don't forget to like, subscribe, and share this video to stay updated on global financial and political trends.